Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and we have our usual two guests this morning. We have centre-back Nick, who has just returned from a nice holiday in Malaysia. And where else did you go, Nick?
South Korea and Japan as well.
Not bad, eh? Not bad. I wish I had a holiday like that coming up.
It's a great couple of weeks.
That sounds great. And Gaurav is now safely ensconced in his new home. All the builders have gone. He sounds so much more relaxed. How are you feeling?
Actually,
now,
we've got the Sparky here because I want to get some batteries put in. Just have to upgrade the electrical gear. But this battery scam that's going on, it's very good. If you haven't gotten batteries in your house yet, it's just such a no-brainer.
Yeah, it really is. Hot water heaters, batteries, and solar power.
The power price, the electricity price in New South Wales during the day is practically zero.
Yeah.
And all you need is batteries. Then you fill up the batteries during the day when it's zero, and you release it in the evening when it's a lot more expensive. Like the payback period when I did the sums, it was about 2-3 years.
Oh, it's
just
it's
a no-brainer. You don't even need the panels.
And you don't really need the batteries at home if you've got an electric vehicle, which does vehicle to grid. So you plug the car into the house, and then the house runs on the battery in the car.
Except then when you need to go anywhere, you're flat.
Yeah. Obviously, you can't. Unless you want to put the house on a trailer. That does make it difficult. But if you're home...
That's phase 2 of the plan.
Okay. Let's get going, shall we? We are going to kick off. We've got 2 segments today. The first is on a big winner that we've had this year, and we think there's some important lessons for listeners to discover in that 700% gain, which is an 8-bagger, I believe. I think the maths are correct. And then we're going to talk about the ongoing catastrophe at the governance capital of Australia on the ASX, which is WiseTech, where 4 non-exec directors resigned a couple of months ago, and there are now no non-exec directors at WiseTech. Is that right, Nick?
No, not quite. They've replaced the 4 independent directors, but there's many other
with less independent directors, I bet.
It says something about the ASX that when you introduced it as the governance capital, we had to think about, hang on, which company might this be? There are several candidates.
That's right.
There were several candidates just last week.
Yeah, that's right.
There was. Well, look, let's start off with something less complicated. So we first reviewed a software company that delivers mining software to companies around the world, mining companies around the world. It's called RPM Global. We wrote it up in mid-2016 to describe the business, which had a consulting business attached and was growing its software division. And we first made our initial recommendation in 2018 at, I think, a price around 45 cents. Is that about right?
I believe so.
Maybe a bit more than that.
I think it was more than that. It was in the 50s, I think, 55.
Yeah, we recently sold out at $5 a share. So that's an 8-fold return over, 7 years. So a very successful recommendation. But there are some good lessons in it for us, I think. Gaurav, why don't you start off, because you're the analyst on the stock. What was it that made RPM Global attractive in the first place?
At first, it started out almost as a classic mispricing, I think. It wasn't obvious that this would be a high-quality business from the get-go. And, of course, we can look back now. It's been taken over at a big multiple, and you can see from today's financial results that this is a high-quality business and it's growing. But that wasn't the case then. So it started off as the software business presenting an option value that wasn't really embedded in the price. I think a lot of good ideas start as free options or as mispricings rather than obviously coherent, thought-out thesis. And I think a feature of RPM has been the way we've built conviction as time has gone on. I don't think it was a magnificent idea on day one. It was an interesting idea and certainly worth allocating cash to. But over time, as the idea got proven, and as we found out that the business economics were outstanding, and as those economics got better, and as the software sales grew, then it became a lot more of a no-brainer. I'd say the last time we had a buy on it somewhere in the $2 range, it was almost a no-brainer. At that point, it was a sort of a high conviction. You could see what we did in the funds. It was our largest position for a long time in the funds.
Yeah.
That's when it became a no-brainer. It wasn't. I mean, I've heard a lot of members talk about how they wish they had allocated more at the start. I think that's an error to allocate too much money to a small mispricing that may or may not work out. That's based on option value.
Yeah.
It's later on in the piece where all your ideas are coming together and the business proves itself. That's when you jump up your allocation, and that's when it becomes a really good idea. And I think we got both those things right. We got the initial recognition of the option value and the mispricing right. And then as the business got better, we recognized that. And certainly in the funds, and I hope in the writing, it was very clear that this became a good idea.
Yeah. So I think that gets to the heart of why we found it attractive in the first place. It did have a software business that was really growing pretty well, but there was some complexities to it that made it cheap, because most people didn't really understand the value of the software business because it was hidden by a consulting business.
Not just that, John. I would also say that the software business itself presented as poorly. If you knew that there was a software business embedded, the economics were not great because it used a SaaS model. So it was replacing perpetual license revenue with much smaller but stickier SaaS revenue. And that interaction made it look as though revenue was falling and profitability was declining. You had to understand the revenue dynamics and the accounting to see that would actually be beneficial for the business.
That's what I was going to say. It was software was sold. You said it much better than I did. I will admit that. But the software was sold on a contract basis. And over the long term, a SaaS business where you charge monthly or annual fees is probably a lot better business, especially with something as sticky as software in mining. But that hid the value of the software business because of that complexity. Is that right?
Yes, that's right.
Okay, so I think that was the first lesson. You find that attractively priced companies often have imperfections, and it's the imperfections that make the price relatively attractive. You've
100%.
got to look past those imperfections in order to see it.
I really want to underscore that because I think that's something investors again and again fail to appreciate. They say this is a great business, but this would be a good idea, except I would buy this, but for. It's that exception. It's that last sentence that creates the opportunity. It's the imperfection, the problem, the wart, the except for. That's the bit that gives you the opportunity. You need that. So don't run away from problems. Try and understand and unpack them and have a path to how those problems can be solved. And that's the opportunity. Like we wouldn't, if RPM had existed in its current form with its current economics, we would never buy it.
No way.
The opportunity wouldn't be there.
No, it would be like buying Pro Medicus, like a crap version of Pro Medicus.
Well, I think Pro Medicus probably deserves its own little basket because I've been looking at that, and my goodness, what an amazing set of numbers that is. But we'll get to that another day. But it's like buying Xero, right? Yeah. Like I have no interest in buying Xero, even though we can recognize it's a great business. Or Tech One. I have no interest in buying Tech One, even though we can recognize it's a great business. I think RPM would have been in that bucket. You know, embrace the problems and look for those warts, because those are the things that get you your returns.
Yeah, agreed. Nick, have you got any comments on that? The idea that, buying attractively priced companies often comes with problems, and the problems are the source of the opportunity often.
Yeah, absolutely. And I think one of the things here is that you just can't screen for them. Like, so you can't screen for an 8-bagger. There's got to be a little bit of a problem. You've got to dig, deeper than just the financial statements to see what's really going on and to, create conviction in an investment thesis. RPM's that classic case. Other cases are like where there's a loss-making division maybe that's obscuring a really profitable business. It could be new management comes in with fresh ideas or closes a division. Could be there's lots of things, but yeah, you want to, as Gaurav says, you don't want to just exclude what look on paper like bad businesses. RPM may not have been a bad business, but just excluding stuff and screening them out, I think, is a really actually poor way of finding ideas, and you tend to find the same 20 ideas. You mentioned Pro Medicus and whatever else that everyone else does, but the big returns probably aren't going to be found there. They're certainly not found there after those stocks are already up 10 or 20 times. So yeah, you got to embrace the pain a little bit, or the uncomfortable.
Yeah. Now I will say that moving on to the next lesson, the importance of really high quality, capable management. Gaurav, do you want to speak to that? Because we were always very impressed with the CEO, Richard Matthews. He had a great history in developing software businesses. That helped us overcome some of the fleas that we mentioned in the first part of our discussion. The fact that he was so capable. You want to talk to the management capability in this business and their stake in it too.
Yeah, I think that all was really important because it helped build. It didn't help in understanding the business, but it helped build conviction in it. And you can select stocks based on your understanding, but you can only make money based on your conviction. And if you don't have conviction, you'll never make money. So the understanding management is really about building conviction in the stock. And I remember before we took a big chunk in the fund, we set up a meeting with Richard Matthews, and because we were quite early to the buying the stock, he agreed. Even though he's quite difficult these days to get a hold of, back then, we had a good hour and a half with him, and that really helped build conviction. Not because we got any inside information or anything; you just got a sense of how this person thinks. I didn't really appreciate that. He had sold several businesses, made lots of money, but came back and saw RPM as a problem to be fixed. Put down millions of dollars of his own money, not in share options, not in incentives, but of his own money laid down day one, and bought a stake of that business, took over management. And what really got me over the line was that he bought an entire team with him, an executive team that he had worked at in previous jobs. And so it wasn't just one person coming across. It was a whole team of people that had worked together, that had an embedded culture, and that had done exactly this thing before. And they all came across and did it again. Yeah. There's no better sign for me than that when a whole team comes across. When I look through management, it's not just the CEO I'm interested in. Mm-hmm. Has he worked with these people before, and do they have a relationship where they've done something together? People who do well together like to work together, and you want to follow those people around.
Yeah. And that team set to work and they started to invest very heavily in R&D, software development, basically, to build out the products and to develop their capabilities. Then what we saw was the sort of economics of low marginal costs start to play out once they started acquiring new customers. Do you want to talk to that? Because I think this is at the heart of why software businesses are so good.
Yeah, look, it's worth pointing out that when he first came on board, you could easily read his beginning and his early moves as a warning sign, because he came in and made lots of acquisitions. He bought iSolutions, a couple of big acquisitions to beef up the software division. And sometimes we see new CEOs come in and make big acquisitions, and that's a red flag. I think this is why it's important not to have a checklist of things. I mean, you really have to investigate everything on its own, not just tick boxes, because sometimes that is a red flag. But in this case, he bought at the bottom of the cycle. And he gave strategic reasons why they were buying these businesses and how they would integrate into what they were doing. And after he had finished spending money, he then started building sales. And you could see that in the numbers as well. So early on, I think the stock fell quite a bit before it started to rise. I remember buying some in the early 40 cents, and I know it got down to 30-something cents. An initial buy was something around 50 cents. So it definitely fell before it started to rise because the numbers looked really bad. But that was just a reflection of him building the business. And so maybe that's a lesson in itself, is that I really dislike these checklist approaches because I think you always miss nuance, and everyone is using these screens and checklists And if you can be the guy who's using nuance, you get to pick up the opportunities that other people miss. And that's exactly what happened here.
Yeah. Nikki, you got any comments on that? You see that in other businesses?
Yeah, I mean, just on management, I think particularly on the ASX, the smaller the market cap, and I think RPM at the time of the initial recommendation would have been probably $100 to $200 million market cap. Yeah, I think the smaller the market cap, generally, the more important management is to the outcome you get. And so, having Richard Matthews there was a big plus in hindsight.
Yeah. And I think the final lesson really was the holding period where you've got all of these good things working for you and they're just getting a better business day by day. The market might not see it. The share price went sideways for quite a few years, really, between sort of late 21 and even last year. And then we got this huge increase in returns just in the last, 18 months or so, when the price was around 160 and then it eventually got taken out at $5. And it makes it look as though everything happened in the last 18 months. And it kind of did, share price wise. But that was only a function of what the company had been doing in the 8, 9, 10 years previously. And this is, I think, that is a really, really important lesson, that compounding isn't just a financial thing. It's a business thing too. You want to speak to that, Gaurav, the benefits of holding good, growing companies over time? Because when you look at the numbers, this is where you make your really big returns.
I think that's one thing we did better here than we typically do. I think we're very good at finding stocks and ideas. We're less good at holding them for a really long time and letting time do its work. And I think this is a case where we did that perfectly. There were lots of times where the valuation looked silly, where we knew it was overpriced for that moment in time. But we also knew that there was a lot of growth ahead of it. And there are times where you just have to sit there holding an overvalued stock. Because being a long-term investor is not just holding cheap stocks for a long time, it's holding quality for a long time. And the returns came from compounding. I mean, if we had jumped in and out the way investors typically do, especially fund managers typically do, but jump in and out of these stocks, I think that makes these kind of returns very difficult. You just got to stay on board, even though you recognize things are expensive.
I think the other thing too is just the patience, not only in the last 18 months, but I went back and had a look, and the first 18 months after the recommendation, the stock actually was flat to slightly down. And I think that's a really important lesson, that you've got to give your investment thesis time to play out. And it's an important lesson in today's market where a lot of people aren't doing that. There isn't a lot of patience. But we really showed a lot of patience in that first 18 months that allowed us, to get the big return as well.
Yeah. And one of the nice things about it at the end was that we didn't even have to make the decision to sell.
Yes. That was fortuitous. Yes.
Which is great, because I do find that a hard decision. Selling, I think, is harder than buying in some ways. But this,
in every way.
Every way,
it's harder.
Every way it's harder. And this was taken out by a competitor. It's been purchased by Caterpillar. And that made that easy. And the work was really done very quietly and very slowly by the management team. And, what we had to do was just be confident enough in that to hang on. And the beauty of it is that didn't require much intellectual effort on our part, right? We didn't stress over this company. We didn't have any concerns. We didn't worry. In our Monday morning meetings, there's often like a continual complaint about what this company's doing and what that company's doing. We just didn't have that with RPM.
I'm glad you didn't think about that. It's a good point. It's a good point. I think that comes back to trusting management, right? We knew Matthews had put down a significant amount of his own money. And there were times where the actual sales didn't come across, or they went through this period when they had this funny reporting where they reported profits before management incentives. But I remember being on a call and someone raised that issue, and Matthew said, okay, when you say it like that, it sounds kind of silly. We'll change that. Won't do it next time. And next time they didn't do it. I think that kind of thing built confidence in the management, because they weren't. Matthews wasn't very. He wasn't very experienced in public markets, and he was making errors. He said he was very unpolished, and he did things wrong sometimes. But every time he did something wrong, he came back and corrected it, and that built a lot of confidence for me. Anyway, you're right, John. I never I never worried about it. I held my stake. I didn't sell a single share until I needed to sell to buy the house. And it's funny that I'm sitting in here talking about RPM, because RPM funded a lot of the purchase of the property. I mean, it's holding on and not worrying about it. Yeah, I think the older I get, actually, the more I think if you're too smart at this, and if you think too much, and if you do too much, it's all to your detriment. The share market is actually set up to reward sloth and laziness. So maybe
they're my kind of characteristics.
But I was going to say, John and we're right at home in this game.
Okay, we're going to take a quick break, and then we're going to be back with quite a different company.
The market never sits still, so staying ahead of the curve matters. Intelligent Investor Premium helps you invest smarter without spending hours on research. You'll get buy, hold and sell recommendations on more than 80 Australian and international stocks, special reports on big investment themes, market insights, interviews and Alan Kohler's popular weekend briefing. The best part? You can try Intelligent Investor Premium for free for 15 days, even if you've tried it before, and you don't need to provide any credit card details. Just visit intelligentinvestor.com.au.
And we're back to talk about with Nick WiseTech. Nick, where do we start with this company, right? And the person who founded it. Like, where do we really start?
Oh, I don't know. WiseTech is it's a bit of a basket case at the moment. It's a real difficult one, and I can see why some investors put it in the too hard basket. On one hand, you've got the company which is kicking all these own goals. It's not that dirt cheap. The risks are high, particularly because the balance sheet's quite levered now. But then on the other hand, you've got what might be the best software business ever developed in Australia, and that software specifically is CargoWise. So it's really hard to sort of balance both those things. I think the big issues for me are accounting, leadership succession, and also this execution risk, particularly because of where the balance sheet is. If you look at the accounting of this business, I mean, it's pretty poor for a company of this size. They're not doing anything illegal. This is all within the rules. It's just how they present things. So free cash flow, for instance, they exclude real costs like tax and interest, and so the free cash flow I get and the one they give are miles apart. And then that's not even the worst of it. The capitalization of R&D here is another thing that's just got to a point which is made sort of.
Do you want to explain what that is?
Yeah, so essentially, when you spend research and development dollars, if it's research, you're supposed to expense it all. But if you can sort of prove that the spending has, so it will result in future revenue, you can capitalize that, and you can then amortize that through the P&L over a certain period of time. And so the more money that's capitalized, the better the profit and loss statement looks. And so other companies, so I think RPM was one of them. I think they expensed all their R&D. Pro Medicus expensed all their R&D expense, whereas WiseTech, I think, capitalised now 55% of their R&D expenses, and that's hundreds of millions of dollars.
Yeah. Now, just be clear about this, because what you're doing is you are treating salaries as would Qantas. In an accounting sense, you're treating salaries in the way that Qantas would treat the purchase of an Airbus.
Yeah. Essentially, you're right, because those salaries are developers, and you amortize those costs. But yes, you're right, and so that spreads those costs out. I think WiseTech spreads them out between 5 and 10 years, and so this really makes EBITDA, almost
massively overstated.
Yeah, it's overstated.
That's the number they keep reporting, which is
exactly.
Very.
Yeah, and so when you've got a business that's also saying, our net debt to EBITDA is 4 times, well, actually, that EBITDA is overstated, so it's probably a lot higher. It's a very generous figure. So yeah, the accounting's been, the accounting treatment's generous and a bit tricky, and I just think unbefitting of a company that's was in the ASX top 20, I believe.
Can we just underline that a little bit, Nick? Because I think that this is such a crucial point, and you never read about this. Because WiseTech is a beloved business, or certainly was. This never gets brought up, but you've done really good work on this, and the growth in the margins I find particularly disturbing because everyone
they're not growing.
With the margin growth.
They're coming down.
Yeah.
But the margin growth has all come from changes in the capitalization of software.
Yeah.
Like if you take that out.
Yeah. Margins are still slightly growing, but nowhere near to the same extent as what they're reporting them as. Yeah. And sort of each year, I followed this company for a number of years, and it was like, oh, we're now doing 45% capitalization. Then it was 50. Now I think this year's going to be 55. And each year it's just going up slightly. And it's like, it's a massive red flag when a company is doing this. And they, say, oh, we've got some new products that are, on their way, and they'll eventually produce revenue. So that's why we're doing it. But
that's fine. To do that next to claiming your margins are going up, that's the difficult part for me to put together, because they're saying that, look, we're scaling, our margins are rising. At the same time, I'll be generous. Almost all of the margin growth has come from capitalization changes, and there's the company sitting there claiming that they're scaling beautifully and growing margins, and it's just a fiction.
100%. And so the better measure of profitability for this business is just to track its free cash flow over time. Yes. But again, don't trust their number for it. You have to actually go and do the calculation.
Incredible that you have to do that. Yeah.
Because that doesn't the free cash flow calculation treats R&D costs, just we sort of take them all off. So there's no changes there. So that's the first sort of red flag, and we've sort of been
that ought to be enough, really. Like if that was the only red flag, I think that'd be enough.
There's many more. Look, we're running out of time. If we talk about all of WiseTech's problems, we're going to be here for another hour. Let's just go into what might be politely called governance issues.
Well, the governance issues are like the actual. What holds me back from investing in the stock, other than accounting and all these other things, is it's not so much the governance issues, but it's the link between governance issues and succession. And so that's a real issue at the moment. There's an ASIC investigation into alleged share trades by Richard White and other employees. And I want to stress that innocent until proven guilty, and there's been no charges laid. But you need to think about succession in this business. And they've recently put in a new CEO who has no experience running a $20 billion company, and that was previously a WiseTech employee and worked closely with Richard White, who is now the executive chairman. But in my book, it looks like he's still firmly in control of this business. And one of the proxy advisors before last week's AGM actually brought up that they questioned whether he would, because of his prior relationship, whether he would be able to stand up to White if necessary. The other problem is if you go back if you go to the board, they've recruited 4 new independent directors after 4 of them resigned because of irreconcilable differences with White in February. And these 4 directors, and this is a bit of a red flag for me as well, they have no experience or little to no experience on an ASX 50 board. They have little to no experience running a multi-billion-dollar software business, and it's a bit of a red flag that WiseTech couldn't attract candidates with better CVs or with more experience, particularly at a time when they needed to show that there were some people in here looking after the governance issues, and they chose not to do that, or they couldn't do that, and that's a bit of a red flag for me. Again, this is, well, at the time these directors were appointed, was an ASX 20 business. There should be, corporate leaders around the world chomping at the bit to, get on the board of these companies, just as they would for a Macquarie or a Commonwealth Bank or any of these other, large cap businesses on the ASX. But that wasn't the case. So that's a bit of an issue, and succession is, an even larger issue than it was a couple of months ago, because they've now gone and bought E2 Open for $2 billion. There's a lot of leverage on the balance sheet. There's now massive execution risk. If there is, movement in management or resignations, that execution risk and integration risk just amplifies. And so the business is, in a really tricky spot at the moment. And look, the reason we're talking about all this and not just saying, okay, too hard, too many problems, is because CargoWise, their main software business, is excellent. It's absolutely sensational. It's mission critical for most of the world's largest freight forwarders. So I think 14 of the top 25 are now in global rollouts of that software. The top 10 customers now spend $21 million a year with WiseTech. That's up from $8 million 4 years ago. The software's experienced less than 1% churn over the last 12 years. So it's as good as it gets. And so what we've done in the newsletter is we've introduced a crazy, stupid price that would be willing to pay for it.
It's crashed through it.
Well, no, we've introduced a new one. And
hold on. Can I just give the listeners some sort of context here? So we're the seller above, like the high, WiseTech's high was about, when was it? August, about $120, something like that, and it is now is now almost halved. It's down to $66. And when we looked at the result in early September, it was 99. So it's down another third between September and November. And we had a buy below $70 at the time of the result. So we're updating that, Nick. What's your feelings about where this is going to go? Because, from this discussion, I know that there's a price that you would pay for every business, but I just don't know how low it would have to be to buy this with Richard White still at the helm. Like, he's clearly important to it, but he also brings with him even more problems than Ellison at MinRes. Yeah.
Well, that's true. And look, I won't reveal what the price is. Members can go and read that, but it's lower than where it is today, significantly lower. And think of it as a point of sort of maximum pessimism, where fear rather than rationality is really driving investment decisions. And look, you have to appreciate that some of these issues, like for example E2 Open or even the leadership succession question, can be solved. They could bring in a high caliber CEO tomorrow. They could improve the board. They could maybe get rid of E2 Open, or E2 Open could really work. Granted, they'll still have to pay the debt, but I think they can. Because what I don't want to do is throw this business out because of how good CargoWise is. But we might get a point where investors do throw this business out, and I just want to be, prepared for that.
Yeah.
So I don't. So as harsh as I've been, and realistic as well, I do appreciate how good CargoWise is. As I said, it's maybe the best piece of Australian tech ever developed. It certainly has, all the characteristics we look for in a software business. There's just everything else going on.
Just everything else. There might be a tension between our two topics today. I know some people might be listening thinking, well, isn't this the wart that you guys were talking about earlier?
That's very good, yes.
And I would say that again, this is why we don't use checklists and unthinking rules, because the wart, there are limits to what we're willing to accept for a wart. You guys have seen Succession, right? There's that great line where the old man says, "You're not serious people."
Yeah.
And that just shuts down the entire conversation. You could say that about the entire board of WiseTech. These are not serious people. This is a joke of a board, and that for me is the line.
I'm disappointed that I didn't get the call, actually.
Yes, that's right. That's where we're at, John. I think it was realistic.
That's where we're at.
But yeah, so there are warts and there are warts, and this is the second variety.
And I just added one thing we haven't actually touched on, is the valuation isn't cheap yet. Yes, the share price is halved, but it's halved from, a price to earnings ratio that, again, I think is generous of, sort of 120, 150 times. So it's not cheap by any means. I think it might be on 70 or 75 times trailing free cash flow. So there's not like valuation support either. Like the valuation can certainly come down from here.
I would much rather buy, like at the height of the sort of tech bubble in Australia, what was it, mid-year when WiseTech was at 150 and PR 150 and Pro Medicus was at 300 or something. I would rather buy Pro Medicus at 300 than WiseTech at 150.
Yeah, agreed.
Yeah.
Okay. I did ask you guys for a cultural recommendation. Thanks for that, Nick. That was excellent. And I don't think we're going to get any calls from the lawyers. So that's even better. I did ask you for a cultural recommendation. Have you guys got anything for the listener who wants to listen to something more serious and informative and entertaining?
I don't have anything to listen to, but what I would say, I just spent about 2 weeks a bit over 2 weeks in Korea and Japan, and I know a lot of Australians have gone, particularly Japan, but get over to South Korea too. It's more different than I thought between Korea and Japan, and I had a great time there as well. So yeah, if you like traveling, put it on the list.
All right, Gaurav.
Look, I'll go a podcast. Look, I'm getting a bit podcast out. I'm probably I've stopped listening to podcasts now, really, and I don't listen to many of them. But there was one that popped up just this morning. I've been listening to that all morning, and it's Joe Walker's podcast, formerly known as the Jolly Swagman. He's got a 4-hour interview with Hugh White, who's a legendary strategic thinker. Yeah. And this is fascinating. So they're going through a number of books that Hugh White's think are seminal for understanding international relations, and they're discussing those books. And I think it's really interesting. So if you've got a spare 4 hours. And I don't listen to podcasts often, but this is a good one.
That sounds good. That is on my list, actually. It's in my feed already, ready to go. My recommendation is an Outback crime drama called Thou Shalt Not Steal with Noah Taylor and Miranda Otto. It's just really fantastic. It's got all the sort of disgusting pubs, the cars, the caravans, the sort of the roughness of the Outback, and two sort of bruised young people who are trying to escape and find their way in the world, and they're dealing with all of these arsehole adults. And it's just a lot of fun. It's hilarious. It's got sort of a deep heart, and it's kind of uplifting. And if you lived in Australia in the 80s, I think you'll love it. So, go for that.
There better be some denim, John.
Sorry?
There better be some denim.
There is some denim in it. It's a bit hot for the Outback denim, really. It
has to be denim jacket and denim pants, the combo.
Those tight shorts from Kmart. What would they call those? I can't remember. Anyway, it's on stand. All right. I think we call it a quits there. Thank you both for your time this morning, and we'll be back in 2 weeks. And don't forget our Black Friday special offer, which is pay $300, get Intelligent Investor Essentials for the next 12 months and get 3 months of the Intelligent Investor free. Go to our website for more details. Thanks very much, and goodbye.